Global corporate finance is built on a single dominant mechanism, the issuance of interest-bearing debt. When a conventional institution needs to raise capital, it borrows money and promises to pay it back with a predetermined percentage of interest. Islamic law, or Sharia, strikes that mechanism down. It strictly forbids riba, the payment or receipt of interest. Charging a fee simply for renting out money is considered exploitative and is strictly prohibited. The restrictions extend beyond just interest. Sharia also prohibits gharar, defined as excessive risk or uncertainty in a contract, and strictly bans capital from flowing into haram, or forbidden activities. Every transaction requires absolute clarity and ethical compliance. Standard corporate bonds, which promise a predetermined fixed rate of interest and trade based on speculative fluctuations in the market, directly violate these core Islamic principles. To access institutional capital while remaining compliant with Islamic law, the financial architecture has to be rebuilt. It must abandon the traditional debtor-creditor relationship entirely and replace it with a model based on risk-sharing and physical assets. The core economic premise of Islamic banking is straightforward. Money cannot organically generate more money on its own. It is a medium of exchange, not a commodity to be rented. Generating a profit is allowed, but that financial transaction must be directly tethered to the purchase, sale, or lease of a tangible asset. This creates a mandatory requirement for risk sharing. The financial institution and the customer must divide both the potential profits and the potential losses of that specific asset, based on clearly agreed upon terms. In a conventional debt structure, the lender is completely shielded from the underlying company's operational losses. They expect their interest payments regardless of how the business performs. Islamic finance eliminates that shield. Because capital cannot be arbitrarily priced and rented out for a guaranteed fee, facilitating large-scale corporate investment requires an entirely different legal framework, one that legally turns lenders into owners. This framework is realized through a financial instrument called the Sukuk. While market participants often colloquially refer to them as Islamic bonds, that label is legally and mechanically inaccurate. Sukuk are certificates of ownership, representing an undivided, proportional stake in an underlying asset, like a commercial tower fractured into equal shares. Holding a segment earns the legal right to a proportionate share of profits generated. Conversely, proportional ownership mandates proportional exposure to operational losses. Sharia rules dictate that overarching financial guarantees cannot be embedded into these contracts. The investor has no external protection guaranteeing the return of their initial principal. The Sukuk complies with Islamic law because it executes a genuine transfer of tangible risk and reward. It replaces the prohibited relationship between a debtor and a creditor with a valid partnership between co-owners. The Accounting and Auditing Organization for Islamic Financial Institutions outlines several permissible ways to structure these transactions. The most widely adopted and classical model is the Sukuk al-Ijara. Ijara is an Islamic contract that defines the legal transfer of a tangible asset's use to another party in exchange for a specified rental payment. The mechanics begin with the originator, the entity possessing a tangible asset and needing capital. Next, an independent company is incorporated to execute this transaction, the special purpose vehicle. The originator sells the asset to the SPV, moving true ownership into this isolated company. This transfer is a strict legal necessity. True ownership must be fully extracted and completely unencumbered by the originator's broader corporate debts or operational risks. Establishing the SPV creates a clean slate. With the asset legally isolated, the structure is safe to invite external capital into the equation. This brings in the third party, the investors, supplying institutional capital. They pool their funds and transfer cash into the SPV to finance the purchase of the isolated asset. In return, the SPV issues Sukuk certificates back to the investors. These specific certificates are simply not IOUs. They legally represent the investor's undivided, fractional ownership interests in the physical asset now sitting inside the SPV. The SPV immediately takes the cash pooled from those investors and uses it to finalize the purchase payment back to the originator. The SPV operates as an essential mechanical bridge. It converts external investor cash into physical ownership, enabling the originator to secure large-scale funding without taking on a single interest-bearing loan. This presents a structural challenge. Institutional investors require highly predictable, fixed income-like cash flows, but Sharia law strictly forbids guaranteeing an interest rate. The Ajara structure solves this by ensuring the asset is leased right back to the entity that originally owned it. The originator regains full operational use of the asset for a predetermined timeframe. This timeframe corresponds exactly with the maturity term of the Sukuk certificates. In exchange for using the asset, the originator makes a steady stream of payments, explicitly defined as rent, into the SPV. The SPV collects this rental income and immediately distributes those funds directly to the investors. This specific distribution provides a strict pro rata return. Investors receive their rental payouts strictly in proportion to the percentage of the asset they own. The leaseback mechanism precisely mimics the predictable cash flow of a conventional bond coupon, while operating entirely as a Sharia-compliant rental agreement. One final mechanical requirement remains. At the end of the lease term, the investors need to recover their initial principal, but standard debt repayment guarantees are invalid. The solution is a binding legal mechanism established on the very first day of the issuance, the purchase undertaking. This document grants the SPV the legal right to force the originator to buy the asset back at maturity. The originator pays a predetermined lump sum into the SPV, which pushes this final pool of cash out to the investors, and the Sukuk certificates dissolve. The purchase undertaking provides the final liquidity event. It unwinds the fractional ownership structure and successfully completes the fixed income simulation. The mechanics of the Sukuk al-Ijara are highly precise. It cleanly replaces interest with rent, and it replaces unsecured debt with fractional physical ownership. Because its structure is transparent and logically sound, it is widely accepted by both strict Sharia scholars and conventional international rating agencies. This dual acceptance has facilitated significant sustained growth across primary Sukuk issuance and generated highly active secondary trading markets globally. The Sukuk operates as a highly sophisticated evolution in structured finance, allowing global wealth managers to deploy capital efficiently while remaining entirely tethered to tangible economic reality.